It's been 10 years since the collapse of the Lehman Brothers, the event that sparked the worst day in the history of the Dow Jones Industrial Average and prompted the global economic crisis that wiped trillions of dollars off the global economy. But have any lessons been learned about leverage, bank capitalisation and risk? I'm Eddie Taylor, and on today's issue of Inside AB, I'm joined by Shayan Shakil. Thanks for joining us, Shayan. So quickly take us back to September 2008. What exactly happened and why?
Well, in September 2008 is when really the screws fell off the economy. Lehman Brothers, who had at that point been the largest lending organization that was involved in the subprime mortgage crisis, all its bets just fell through, and the company pretty much collapsed. The scars, the shockwaves from that are still being felt today. The Dow suffered the largest single-day drop in history at that point and triggered a 17-month recession in the U.S., which of course, was felt the world over because the U.S. markets are so exposed to European markets and in Japan and vice versa. So really, that's what triggered. And in the GCC, we did feel that in November 2000, so about 14 months later, and it really just kept going worse until about March 2009 when the Dow fell to its lowest point in the decade since or the decade past.
Right, and we're talking a big collapse here. It sort of reached about 14,500, roughly that kind of level in 2008, and then it fell all the way down to around about
6,500. Yeah.
These levels. So it was a real precipitous drop in the stock market. And as you say, it was all driven by the subprime crisis, where deregulated banks and financial institutions sold mortgages to people that couldn't afford to pay them, bundled them up in complex financial structures, flogged them to bondholders around the world, and then the minute somebody defaulted, the whole kind of edifice came crumbling down. So what did this lead to in terms of regulation and laws?
Well, because the essential problem then became, first it was debt, then it became liquidity. So people just didn't have enough cash. What the banks started doing, the economy would have stopped working practically in like a few days. The global economy was just shut down. Because what happens is that the cascade, if one person isn't lending you money, then the other person can't lend it forward, then they can't lend it forward, and after that. So the entire bank's fractional reserve system had just fallen apart.
And for every dollar that a bank was lending pre-crash, there was about sort of 30 times that figure out on loans that then became bad debt.
It was incredible. It was all on the books and none of it existed in an actual form of like cash.
And the assets they were holding were suddenly valueless because there were foreclosures and then there was oversupply and then there was a building boom. So it was the worst possible kind of collision of events, wasn't it?
Oh, we saw company values decline because asset prices fell immediately after people realized that nobody was going to be able to pay for these. So what the banks did, because the essential problem in the beginning was that there was no cash left in the economy, is that they dropped interest rates down. So that meant that it increased the money supply in the market. And when that happened, people finally had some way to pay back some of their debts. They couldn't pay all of it because the book value of all those debts was meaningless at that point. So that's one of the things that the banks did. Lots of bailouts. We saw the U.S. bailout Citibank. We even saw, I thought the Cash for Clunkers program that George Bush had initiated was strange. But, Obama started bailing out, all these banks. And there was very few ways at that point. Hindsight is...
There were forced mergers and forced acquisitions, weren't there?
Bear Stearns was sold.
Bear Stearns was sold. We now have Bank of America Merrill Lynch, which is obviously the result of a merger there that was basically forced upon the sector as a way to kind of keep these massive too big to fail banks from going under. And then that led to legislation, the Dodd-Frank Act, which is probably the most important one.
Absolutely, and some of those provisions of that act were, of course there would be regulation of ratings agencies, which really is quite essential. And if you haven't watched The Big Short, you should. There was greater transparency to retail investors. A number of things really came about from that. There was a prohibition on securitizing assets, which previously financial institutions only a certain kind could do, but people had just really started creating economic instruments out of any kind of asset they had. So that's not allowed, and that led eventually to more closer scrutiny of auditing agencies, which previously had come through the Sarbanes-Oxley Act, the establishment of the PCOAB, the Public Company Oversight Accounting Board, which looked at auditors and regulators to try to make sure that the financial statements were correct.
Separating retail banking from investment banking as well.
Exactly. It was huge because when you have business lines that are merged like that, your capital adequacy ratios are just at that point weren't what they should have been. Basel III was passed a few years afterwards. It's the International Accord for Regulating that sort of activity. And what it now has mandated across the world is that, at least in the UAE, by 2019, next year, banks will have capital adequacy ratios of 15.5%, which means that they must maintain a certain amount of capital based on the risk-weighted assets that they have. And it has separate requirements for tier 1, segregated risky assets and things like that. It's essential to read even further about this, because this was a monumental point in history. It really was felt in Dubai as well. Dubai didn't create the crisis, suffered from an imported crisis, but it did have an effect here.
And the impact on Dubai was very interesting, because it became known really as a real estate crash, didn't it?
Yes, absolutely.
Because of the leverage was mainly used for buying physical assets like property. And there have been some regulations to stop this happening again in Dubai, aren't there?
Yeah, I mean, when you have that sort of value on the book created in terms of debt, then you came to Dubai. I mean, I'm really simplifying the fact here, but you came to Dubai, bought yourself a bunch of assets and new developments in property that was taken hold in the economy between 2002 and 2008. The GDP growth rate was 4.6%, 4.2%. When the financial crisis hit, the liquidity had evaporated, so you couldn't actually get any more money out. That means that the asset prices in Dubai fell by about 60% in some parts. That's what led to the Dubai world crisis, where it asked its financiers to delay payments on debt by up to 6 months. It just needed time to come up with the liquidity for it, but by that time the asset prices.
It was also the means of how Dubai was developing as well. So they were building on land. Developers were building on land they didn't own. They were spending money as it was coming in off an off-plan sale. So they were financing the finishing of buildings with money that was. So when the House of Cards collapsed and the money wasn't coming in, we still see that across Dubai. We still see unfinished projects from that very time.
Some lessons have been learned, though. I mean, it was kind of an important lesson, given that the city has really come out of nowhere in 45 years. Some lessons you have to learn really fast. Now there are escrow accounts that real estate investment transactions are mandated to go through. Mortgages are capped. The Basel III requirements, for instance, in the UAE are being implemented and should come in. They should meet that threshold by 2019.
You have to own the land you build on now,
and stuff like that. I mean,
thresholds in terms of completion rates. I think you have to complete 20% of the building process before you can release money from the escrow account to pay for construction. So things like that have really kind of come in as a direct result of this.
Fantastic, and we might even see more of that coming through as the economy. I mean, the global financial architecture is really trying to minimize that short-term profit.
So where are we now? Where are we now in terms of why are we talking about Lehman Brothers now? Is there are there sort of uncomfortable signs in the global economy?
Well, the most uncomfortable sign is that interest rates are back on the rise again. I mean, banks have just a few ways to affect monetary policy, a few weapons to do that. One of those are interest rates. Imagine if this crisis, the Lehman Brothers crisis, had hit when bank interest rates were actually were zero. I mean, you can't go into negative territory. You can't give people money for putting money into your bank for free. So what would have happened is now the banks are starting to go back to edging up. The Fed's raising interest rates. The dirham is pegged to the dollar. The Dubai banks are gonna raise interest rates. So we're really coming off that quantitative easing that the banks had flushed into the economy to boost liquidity. The easy money days are ending. Now the economic recovery has been kind of shaky because a lot of companies that went on to lend or invest really relied on the central banks quite a bit. So what the analysts are very simply saying is the economic recovery solid enough? Have the fundamentals changed at all in the way that businesses and groups do conduct commerce and transactions? The banks are saying yes, but the banks have also been wrong previously.
And the debt seems to be the issue, because the one thing with low interest rates and cheap money is that public and company debt is now ballooning.
It's at the highest point in history right now. There are countries out there, like Japan has the world's highest debt to GDP ratio. The US has a tremendous debt to GDP ratio. Every year or every 2 years you hear about this conversation about we need to raise the debt ceiling or we're going to shut down Congress. This is why it's happening. There's been economists writing books about this. House of Debt by Atif Miah is a great book about that. The debt is really going to be a problem, and that's what has people worried, because how are you going to pay all this back? So
you've been chatting to people this week surrounding the Lehman Brothers 10-year anniversary. What are they saying about the readiness, particularly here in the GCC and in the UAE? Are banks well set for dealing with any kind of shock waves?
Well, they do have the analysts that we've been speaking to, from various organizations. They're saying, the banks are better capitalized now. So they do have, if they have some risky assets, they have enough in the back to cover that. They also have a significant amount of, common equity ratio, where they have equity vested in those assets themselves. But you can have reasonable assurance that something won't go wrong and that the banks are doing everything right, the lending institutions are doing everything right. You'll never have 100% assurance. And there's so many there's such complexity in the financial system, especially a decade later, like things have become even more complicated, that it's really hard to penetrate that sort of fog that surrounds the mystique of the world financial architecture.
Well, I guess we'll see. I mean, we've had certain portions of the Dodd-Frank Act have now been rolled back. Interest rates, as you say, are on the rise. We've seen emerging markets going through some tricky times, particularly Turkey and Argentina. So there are some signs that we'll soon be in a position to find out, shall we say?
The few warning signs that we've seen, for instance, like Tim Clark-Emmett's has said, there's a mini recession incoming in the aviation industry because of high oil prices. The PA Consulting analyst that we spoke to, the head of the MENA region, he said, despite the economics, what we can't seem to figure out is what the people in charge are thinking right now, because geopolitics has never been as relevant to economics as it is today.
And never been as volatile.
Absolutely.
Where a tweet from a president can take 2-3% off the stock exchange.
Absolutely. And
in a finger click.
And China doesn't even tweet. So
well, that's probably a good place to leave it. Thank you very much for watching. It's going to be an interesting few months as we watch the global markets and see if the effects of the Lehman Brothers will be felt again. Thank you very much for watching this issue of Inside AB. Please comment below and join us again every day at 10 a.m. for more.